Welcome to your channel, Dr. Gazavi. Economics and financial issues are very important. Let's go.
Bitcoin volatility, stock market, and investor sentiment. Are they connected? Bitcoin is a virtual currency that uses an SHA-256 cryptographic hash algorithm and a combination of public and private keys, removing the need for a central authority to check the details of every economic transaction. The trading in this cryptocurrency has become very common, and in December 2017, Bitcoin futures were launched in the Chicago Board Options Exchange, CBOE. Hence, Bitcoin has become a trending topic in financial research, especially when considering investor sentiment. Previous research has proven that investor sentiments extracted from news or blogs, social networks as Twitter, Jorgula et al., 2015, or investor attention from Google, Dastger et al., 2019, influence Bitcoin. Accordingly, we aim to clarify the role of Bitcoin in the financial market and its relationship with investor sentiment. Even though Bitcoin was created as an alternative currency, it is also used as an asset. In this regard, several authors analyzed the role of Bitcoin in stock markets behaving as an asset or as a hedging instrument, and its relationship with other market variables such as Standard & Poor's 500 Index, S&P 500 Index, or the Volatility Index, VIX. While Bardis, 2015, found that Bitcoin price follows the efficient market hypothesis and could be considered as an asset, Lamry et al., 2018, found strong evidence against the efficient market hypothesis. Regarding the hedging capabilities, Burri et al., 2017a, concluded that Bitcoin markets are risky and cannot be considered as a hedging instrument. By contrast, Durberg, 2016a, 2016b, showed that Bitcoin, being similar to gold and US dollar, has hedging capabilities and trades at lower spreads than stocks on prominent exchanges. Moreover, Chan et al., 2019, also found evidence of Bitcoin as a hedging instrument. Nevertheless, Klein et al., 2018, concluded that Bitcoin has an asymmetric response to market shocks, which is similar to that of precious metals. In this manner, there is some evidence that Bitcoin is related to S&P 500 Index, Chan et al., 2019, and to market uncertainty measured through the VIX index. Hence, the objectives of this manuscript are to examine 1. If social network sentiment and stock market, S&P 500 Index, influence Bitcoin volatility. 2. If social network sentiment and stock market volatility, VIX index, influence Bitcoin volatility. And 3. The Bitcoin volatility behavior. We have used AGARCH models to complement GARCH models' results and test the pattern of the Bitcoin volatility since they allow us to guarantee the positive sign of the variance without imposing restrictions on the coefficients. Since it has been proven that Bitcoin can be a speculative asset or a hedging instrument, we have analyzed the behavior of Bitcoin volatility across different periods. To this end, daily data of the S&P 500 Index, VIX, and Bitcoin were used, while investor sentiment was extracted using the Stanford Core NLP software from a social network specialized in finances, StockTwits.com. This measure of sentiment is widely used in research due to its accuracy of 80.7% since it captures the effects of negation and its scope for positive and negative phrases. The results show that financial markets and social network sentiment about them influence Bitcoin volatility. Moreover, it shows different behaviors depending on market conditions. Thus, Bitcoin could act as a safe haven, implying that investors could use Bitcoin as refuge value when Bitcoin markets are stable. Otherwise, when Bitcoin markets have high volatility and stock markets have low volatility, investors could use Bitcoin as a speculative asset. These results corroborate the results of previous studies and advance current knowledge about Bitcoin behavior. Bitcoin has become one of the most important. The correlation between the stock market and Bitcoin during COVID-19 and other uncertainty periods. Cryptocurrencies are becoming increasingly popular as an investment product with incredible returns and high risks. They have also inspired research on portfolio diversification, hedging, and safe haven for other financial assets. Some previous studies have pointed to Bitcoin as a hedge asset against the S&P 500 stock market. However, due to the arrival of COVID-19, an important question has emerged regarding how the relationship between Bitcoin and other investment assets has changed during this period of turmoil. That Bitcoin was not a safe haven for securities because it increased portfolio risk during a high uncertainty period. Thus, in this research, we will examine the relationship between the stock market and Bitcoin during COVID-19 and other uncertainty periods. For this purpose, this research uses quantile regression to estimate Bitcoin returns on the S&P 500 market during low, medium, and high uncertainty periods. In order to investigate the conditional Bitcoin volatility, we apply the ARCH-1 model, introduced by Ling and Mathler, 2003, which is advantageous for observing the spillover effect from the stock market to Bitcoin. This method was also used by Chan et al., 2005, Hamada et al., 2009, and Arauri et al., 2011, to inspect the interdependencies between other markets and the stock market. It is hoped that the findings will contribute to the literature on the effectiveness of safe haven assets in portfolios. Based on the quantile regression results, the stock market's return in the previous week significantly impacted Bitcoin returns during the high uncertainty periods and after the appearance of COVID-19. This research also applied the VAR-1 model to investigate the conditional Bitcoin variance. It found a volatility spillover effect from the stock market to Bitcoin during the COVID-19 period and during other periods of high uncertainty. Therefore, the stock market and cryptocurrency are more correlated during periods of high uncertainty.
Thank you for watching, and please subscribe to our channel. Economic and financial issues are very important. See you in the next video.